James Bullard, the same James Bullard who long pushed the Federal Reserve to begin raising interest rates, reversed course last week and is backing that stance this week.
One of the things I want to do is get away from trying to predict how many increases there's going to be in a year. I mean, we want to be data dependent, and I think we want to better coordinate with markets on the idea that, you know, we will move, but we'll move on good news.
What, if anything, does that tell us about the state of the U.S. economy? If the data does not warrant another rate hike, should we be worried about a recession? On the one hand, Bullard says,
no, I don't think the probabilities are particularly high right now.
But on the other,
of course, you always face risk, and we are at a lower trend growth rate, so you could always argue that there might be a higher probability of recession because your trend growth rate is now lower than it was historically in the U.S.
And that low growth rate is just what worries Citibank, which says we are, quote, in a highly precarious environment for global growth, caused by a large increase in the uncertainty about the advanced economy's outlook, notably for the U.S. Globally, the usual suspects are worrisome. The slowdown in China, rising debt, sinking commodities, and now a new player.
Somehow, if we vote to remain in,
a possible Brexit, in which a UK departure could unravel the entire European Union. Still, Citi says global growth should top 2% this year, but that growth is driven by the United States. Any slowdown here puts the global economy at risk. The IMF, which had forecast 2016 growth to top 3%, also warned this week that it may have to lower expectations.